Hey guys, we're going to cover chapter 16 called investments. We'll probably do this all in one video as well. This is also a fairly short chapter, so we should be okay. But we'll see as we get into it. We're talking about investments, and the first thing we want to look at is why would corporations invest? You need to know these 3 reasons for the test. They are at the bottom of page 3. In illustration 16.2. The first reason would be to house excess cash until it's needed. So a lot of times if you're in a seasonal business, so let's say that you have a ski resort, even in Michigan, that's got its up times and its down times. So if you have had a good winter, and you have excess cash, you would maybe do an investment with that excess cash through your summer. This is done quite frequently with people in seasonal businesses. So that would be one reason. The second would be to generate earnings from investment income. So if you have extra income, personally, it's a good idea to invest it in something that can make you more money. That would be another reason why corporations might invest in other businesses, other corporations, those sorts of things, to generate income on their income. And the third one would be to meet strategic goals, or to basically gain control of a competitor. So you're going to invest in another company that is your competitor, and you're going to continue to buy their shares of stock. And you'll see here in a little bit why that matters, the number of shares of stock that you have. So know those 3 reasons for the test. Then we're going to talk about how we do accounting for debt investments. When I say the word debt investments, always think bonds, because if you had, when we just talked about chapter 15 and we dealt with bonds, we had to set up bonds payable. That's a debt that you owe someone. So when we say debt investments, that means you're going to be investing in someone's bond. So we're going to look now not at selling bonds, but at investing in bonds. So on page 4, we're going to work through those. It says that first thing we need to know, and you need to also know for the test, that when we acquire a bond, it will be done at the cost principal, which means what you paid for it is what it gets recorded for. It will include all costs that are incurred to get that investment. So if you have gone through a brokerage firm, there may be a fee added to that purchase price that gets included in that debt investment amount. So all things included in that cost price. So let's take a look at our book. For example, assume that Cool Corporation acquires 50 Doan Incorporated 8% 10-year $1,000 bonds on January 1st, 2022 at the cost of $50,000. Cool records the investment as follows. We have a debt investment debit of $50,000 and a credit to cash because we bought them. Now, had we bought them through a broker and had there been a $500 brokerage fee, it would be $50,500 as our number to use for the debt investment and the cash. Just keep that in mind, because that will come into play with some of the stuff you're going to be doing for homework. Now, when we issued bonds, we had to pay our bondholders interest. In chapter 16, you're not issuing bonds, so you're not paying the interest. You are the bond purchaser, so you are now going to be receiving the interest. Interest is going to be calculated the same way it was when you were paying it, only now you're on the receiving end, not the paying end. So you're going to handle that the same way, only you don't have to handle any kind of discount or premium on the bond, because you're doing it all at with the cost principle. So that therefore the only thing you're going to record is the interest. You don't have to deal with any of that. Just the seller of the bond does. So it says the Doan Incorporated bonds pay $4,000 annually for interest on January 1st. We found that out by taking the $50,000 worth of bonds. We were acquiring 50 $1,000 bonds, that's $50,000 in bonds, times the percentage of 8. That will give us our $4,000 per year. So on December 31st, we're going to accrue the interest that we've earned for that year. We will get paid that interest then the next day because it pays on January 1st. But we've had the bond all year. Our purchase date was January 1st. It's now December 31st. So we've got to do that adjusting entry at the end of the year that shows, hey, we've earned this interest during this time period. So at that point, we're going to show interest receivable because we haven't received it yet. We're going to receive it tomorrow. And then interest revenue. And the whole point in that entry is to show the revenue, because revenue recognition principle says that revenue has to be recognized when it's earned. We've had this bond through this entire year, so therefore we have earned the revenue during this time of year. So we have to record it. Now the next day then we will get paid the interest. So we're going to get cash. So we debit cash for the $4,000 and get rid of the interest receivable. And that is how you would set it up every year of the bonds that you have for 5 years, because it's a 5-year bond. 10-year bonds, sorry, for 10 years. Now at some point, you may want to sell your bond. So at that point, going on down, we're going to record a gain or loss on the sale of our debt investment. That's the account we're going to use. So it says, for example, assume that Cool receives net proceeds of $53,000 on the sale of the Doan Incorporated bonds on January 1st of 2023. Okay, so we bought them January 1st of 2022. It's now January 1st of 2023. We're going to sell our $50,000 worth of bonds for $53,000. So we're going to, at that point, sell 100% of them. So we would get rid of the entire thing with a credit to debt investments of $50,000, show the cash being received of $53,000. The difference then has to go on the credit side, so therefore it's a gain on the sale of debt investments. Now, if you don't have a 100% sale, then you have to take the percentage of your original purchase. So if we did 50% of our debt investment, then we would go back up to our original purchase and find out how much we paid for it and take 50% of that. Now, in this case, it was no added fees, but if you had that $500 brokerage fee I talked about earlier, half of that would not be $25,000, it would be $25,250. So you have to take 50% of, if that's what you're selling, your original debt investment amount. So make sure that you're doing that. I think we'll have some to work. I know you've got some in your homework, at least on the homework for points. There's some like that. So that is how we acquire a debt investment and how we sell a debt investment. So we're going to go back and actually take a look at a couple. Let me grab my paper clip. So we're going to go back and work a couple on the board. Back to page 24. We're going to take a look at brief exercise 16.1. It says, Owned Bay Corporation purchased debt investments for $52,000 on January 1st of 2022. On July 1st of 2022, Owned Bay receives cash interest of $2,340. Journalize the purchase and the receipt of the interest. Assume that no interest has been accrued. Well, on January 1st, we bought a debt investment. So because we bought bonds in another company, it would be debt investment for the cost amount. And in this case, we purchased the debt investment for $52,000. And we paid for it, so cash is my credit. Now it says on July 1st, we're going to receive some interest. It's in the same year that we are doing journal entries for the year. We're going to assume that it's a fiscal year or a calendar year, either way, of December 31st year end. So we're going to go ahead and just receive that interest now and record it as revenue. We're not going to set up an accrual entry. So we got our cash from the interest of $23.40. And we have to show it as revenue. At the end of the year, then we would do an accrual entry for the other half of the year's worth. So you would have another interest revenue entry like this on December 31st, only it would say interest receivable here. I don't know why they're now saying that you're getting paid halfway through the year. We used to do that every 6 months in the older books. In the most recent books, they've changed it to just annual interest. So I don't know why they threw this in halfway through the year, but they did. But on December 31st, I'd have to have another interest entry that would say interest receivable $23.40, interest revenue $23.40. The next day of January 1st of the next year, then I would debit cash and credit interest receivable for the $23.40. So just so you know that, and these would stay the same every year, unless it was supposed to be an annual, and for some reason you got it at 6 months. I don't know. Do it 16-1. So across the page in the yellow. It says, Kurtka Company or Corporation had the following transactions relating to debt investments. We are going to record those journal entries. January 1st of 2022, we're going to purchase $51,000 worth of 10% Spiller Company bonds for $50,000. So we're purchasing them at face value. Interest is payable annually on January 1st. So on January 1st, we're going to buy some bonds in another company. That makes it a debt investment. And we're going to pay $50,000 for them. So that is the cost that they have to go in at. Then it says on December 31st, 2022, we're going to do an accrual entry for the interest. So we've had them this whole entire year, and it's now December 31st. We have to do an adjusting entry to show the interest that we will be receiving, not today, but tomorrow. So to calculate our interest, you're going to take the $50,000 times the 10%. And get $5,000. It would be 12 months out of 12 possible. That's times 1 for the time, so it's just $5,000. You're not going to get it today. You're going to get it tomorrow. So you set it up as a receivable. And show it as income for this year. This is 2022. We're now into 2023. The next day, then, we get this interest because it's payable on January 1st. So we're going to get rid of our receivable and show it as cash. after we got the interest, then we've decided we're going to sell 30 of the company bonds for $29,000. This is what I'm talking about. It's not a 100% sale, so we're not going to get rid of 100% of our $50,000 debt investment. We're going to get rid of a portion of it. We got 50 bonds here. And here I want to sell 30 of them. So on January 1st, I'm going to sell 30 bonds out of 50 bonds possible, which means I'm getting rid of 3/5 of my investment. So at that point, then I take the 5,000, or the 50,000, I'm sorry, times 3 and divide it by 5 to get the amount of my original investment I am selling. So that would be 30,000. So I have to get rid of 30,000 off of here. I know that I'm getting cash today because I'm selling it, and I'm getting 29,000. Which means I'm off $1,000. And if it is on the debit side, then that is a loss on sale of debt investment. Okay, so loss on sale of debt investment, that might be hard to read. So that is how we're going to handle debt investments. Now, they can also not invest in debt or in bonds of another company, but you can also invest in stock of another company. Remember, a corporation is just like a person. If a person can do it, a corporation can probably do it too. So if you can buy bonds, they can buy bonds. If you can buy stock, they can buy stock. So they might be, instead of purchasing bonds of another company, purchasing stock of another company. So know for the test that the way we handle it is based on the extent of the investor's influence over the operations and financial affairs of the issuing corporation. So the stock, the company that whose stock you're buying, the way we handle it in the accounting is based on how much influence you have on them. So obviously, the more stock you have in their company, the more they're going to listen to you. The more your influence is going to matter. So you start out with a few stock and you're the little fish in the pond. You buy more and you become a little bit bigger fish in the pond. You buy more and you're the big fish in the pond. So we're going to take a look at that and how we handle that as far as accounting goes. If you look on page 6, look at illustration 16.3. Kind of breaks it down a little bit there for you in the amount, the way that we like to take a look at it and how we handle it for accounting. If you have less than 20% holdings in another business, then you are considered insignificant and you will use the cost method. That means that what you paid for it is what you're going to record it at, and it's also what you're going to take it out at if you sell it. Between 20 to 50%, you start having more significant influence on them. So at less than 20, you're the itty bitty little fish in the pond. You're the guppies, okay? The little tadpoles. Then you buy more and you come up to 20 to 50%. The closer you get to 50%, the more they're going to know who you are. Okay. Then you're considered to have significant influence on them. And we will use something called the equity method instead of the cost method. If you have more than 50% in stock in another company, in a corporation or another company, then you have controlling interest over them, which means you can lead them around by their nose, basically. They not only know who you are, but they open the doors for you when you show up. So those are done using consolidated financial statements. And you will need to know how these things work as far as this box goes, knowing that holdings of 20% or less, you're going to use the cost method and that you have very little influence at that point. Know for the test that holdings between 20 and 50 is going to use what's called the equity method, and that you have significant influence on their company. Know that holdings of more than 50%, you're going to prepare what we call consolidated financial statements, and that you have controlling interest in that company. Also know some terminology in regards to the more than 50%. So if you turn to page 8, you'll see probably the information that I'm going to tell you real quick so that we can get all the you need to know this out of the way. Controlling interest is exercised in this case. Talk about who people are. The parent company becomes the person who owns more than 50% of the stock. So if I have more than 50% in another company's stock, I have controlling interest in their business, and I am the parent company. Okay. The subsidiary company, know for the test, is the company whose stock is owned by the parent company. So they would be the subsidiary company to me, the parent company. Also know what I mean when I say consolidated financial statements, and that those are going to present the assets and liabilities that are controlled by the parent company and the revenues and expenses of the subsidiary companies. So those are the things that you need to know from this section from the test. Let's go ahead and go back to the holdings of less than 20% and use the cost method and see how this works. And then we'll go back and work some in the back. So let's go back to page 6. It says, assume, for example, that on July 1st, 2022, Sanchez Corporation acquires 1,000 shares, which is only a 10% ownership of Beal Corporation common stock at $40 per share. The entry to purchase that is going to be taking the $40 times the 1,000. So it's the cost. How much did I pay for it? That's what we mean when we say the cost method. Now this time, you're not going to be debiting debt investments because you're not buying bonds. You're going to be debiting stock investments because you're investing in their stock. So on July 1st, you're going to debit stock investments for $40,000 and you're going to pay for it. So you're going to credit cash. Now, when we dealt with stock before as the seller of stock in 13 and 14, I think it was, we had the opportunity to give our stockholders dividends. Now, we are not the person issuing the shares of stock. We are the person buying the shares of stock. So now we aren't paying the dividend, but we're receiving the dividend. So looking at the top of 7, during the time the company holds this stock, it makes entries for any cash dividends received. So therefore, if Sanchez Corporation receives a $2 per share dividend on December 31st, you would take the number of shares, 1,000, times the $2 per share, and that's what they would receive in cash. And then you would consider that dividend revenue because it's income. It's not income that you made from doing your job. It's income that you made from holding shares of stock. So therefore, it's called dividend revenue. So that's how you would record that. Now, at some point, you may decide that you want to sell some or all of your stock. In the book, it's going to show you how to sell 100% of it again. So down under recording the sale, it says, assume, for instance, that Sanchez Corporation receives net proceeds of $39,500 on the sale of its Beal Corporation stock on February 10th of 2023. So you're going to get rid of what you recorded when you purchased it. So going back and looking at page 6, we debited stock investments and credited cash. This time we're selling it, so we're going to get cash and get rid of our stock investments, 100% in this case. So you're going to flip, basically, those account titles around, but you're not going to get $40,000 in cash. In this case, you're only going to get $39,500. So you're going to record the amount that you're going to be paid for those shares of stock as a debit to cash. Credit your stock investment for the $40,000, which is what your cost was, what you record it for on the other page. The difference of $500 is your loss on sale of stock investment. So it's a loss or a gain on sale of. Make sure that you're using the same terminology as what you're selling in these cases. So before it was loss on sale of debt investments, this case is loss on sale of stock investments because it's stock that we bought. So that walks you through all of the different possibilities on entries that you might have with a small stock holding. Let's take a look at holdings between 20 and 50%. That's going to use what we call the equity method. We do have significant influence in here, so therefore they do know who we are, and we're going to record it a little bit differently this time. Now, when you acquire the stock investment, you're going to still record it at what you paid for it. So looking on page 8, assume that Mylar Corporation acquires 30% of the common stock of Beck Company for $120,000 on January 1st, 2022. So the very first entry is still going to be put in at cost. So you're going to debit stock investments, because again, you're investing in stock of this company, $120,000, and you're going to buy it, so you're crediting cash. Now, for 2022, at the end of the year, what we're going to do is learn how we record entries for stock holdings of 20 to 50%. We have to show certain things and adjust our stock investment account with them. So if you look on the middle of 8, it says for 2022, Beck reports. Now this is the person that we are investing in. We are Mylar. We're investing in 30% of Beck Company. So Beck, the company we're invested in, reports net income of $100,000. It is also declared and paid a $40,000 cash dividend. Okay, so using the equity method, we have to do two things. The first thing we have to do is record our share of their net income, and then the second thing we have to do is record our share of the dividend that they declared that we're going to get. Okay, so we're going to take our Beck's income of $100,000, multiply it by 30% because that's my investment in them. That's going to give me $30,000. Now, if this is net income for Beck, you have to ask yourself, does net income make Beck worth more or less? Well, it makes Beck worth more. So if Beck is worth more, then my stock investment should be worth more. When I bought my stock investment, I debited it. So it wants to be a debit. So if I want to make it worth more, I would have to debit it again. So I'm going to debit my stock investment for my portion of their income to show that my investment is now worth more. And then we're going to put it into an account called revenue from stock investments. And that allows me to show my portion of the income that Beck made because I have a 30% interest in them. That's a middleman interest, so that's going to be the equity method, and this is one of the things we do with the equity method. The other side of that then is the dividends. It says that they are going to declare and pay a $40,000 cash dividend. Again, I have to take a look at it. Well, that's $40,000. I own 30% of that. So 40,000 times 30% is 12,000. Okay, now remember, I'm the stockholder. So therefore, if Beck Company declares a cash dividend to stockholders, that's me. I'm a stockholder. So I'm going to get that cash. So on December 31st, I'm going to record that I'm getting that cash. How much cash? My portion of it, $12,000. And then again, we have to take a look at what this action does to Beck itself. Over here, we decided that net income made Beck worth more. Down here, Beck is declaring and paying a cash dividend. So they're giving out $40,000 of their cash. So in that case, if they are giving out money, is Beck worth more or worth less? Hopefully you said worth less because they are spending their money. So if Beck is now worth less, my investment is now worth less. So I have to adjust my investment by my portion of their cash dividend payment. And this is how we show our adjusted value in Beck Company with these two entries to the stock investment account. That's called the equity method. We're not going to actually do any accounting work for the holding of more than 50% where we show controlling interest. I just want you to know that at that point you are control. You are the parent company. They are now the subsidiary company, and consolidated financial statements get prepared. That's all you need to know for that part. So we're going to go back and take a look at a couple so you can see how this works. Brief exercise 16.2 on page 24. It says, on August 1st, Shaw Company buys 1,000 shares of Estrada common stock for $37,000 cash. On December 31st, Shaw sells the stock investment for $40,000 in cash. So first thing we're going to do is record the purchase on August 1st. If we're investing in someone else's stock, then we now have a stock investment. And remember, it's going to be done at cost price when we set it up, $37,000. And we bought it, so we're going to credit cash. Then it says on December 1st, we're going to sell it for $40,000. So I'm selling it, so now I'm getting cash. I'm selling 100% of it, so all of this is getting sold. And don't forget that when we put this in, if there's brokerage fees or anything else that we've had to pay out to get this stock, that also gets included in this total. But in here, we're going to go ahead and just sell 100%, so we don't have to figure out any percentage of what's being sold. So we're going to get rid of $37,000 worth of stock investment. The difference is $3,000. That would be a gain on sale of stock investment. My stock investment cost me $37,000. I just sold it for $40,000. That's a good deal. 16.3 says Knoller Company owns 25% of Lauer Company. For the current year, Lauer reports net income of $180,000 and declares and pays a $50,000 cash dividend. I'll be right up front and tell you that if it tells you the other company's net income and cash dividends, that you are in the middleman section and you're going to be using the equity method. So that's what we're going to practice here. because that's the only time you're going to need to know that information. So that's going to be a given if you see that in your exercise. So the first thing I like to do is figure out all my numbers and then do my journal entries. So if I'm looking at net income, net income for Lauer was $180,000. I own 25%, which is middleman capabilities there. So some significant influence. So 180,000 times 25% is 45,000. Then Lauer has declared and paying a cash dividend. And they are paying 50,000. Again, I own 25%. So we're going to be looking at 12,500. So those are my two numbers that I need to do. Now we need to take a look at how we do this for the journal entry. If this is net income, then Lauer is worth more, so my stock investment should be worth more. When I buy my stock investment and put it on my books, it's done as a debit. If I want to make it worth more, then I want to do the same thing, because remember, a debit and a debit makes a bigger debit. So we're going to, first of all, show that increase. And then we have to show it as revenue from that source. So revenue from stock investment. Then I have to say, if Lauer is paying out a cash dividend, that's money going out of their business, which means that they are now worth less. Money then going out, making them worth less, makes my stock investment worth less, because my stock investment should go up and down according to what they are worth. So if I am now a stockholder, I'm going to participate in getting some of that cash dividend. How much? My holding worth, 12,500. So I'm going to receive that in cash. And show that it has affected my stock investment negatively. Yes, I got cash, but my investment's worth less because they paid out money. So they are worth less. That would be the equity method. Middleman holding equity method. Next, we're going to take a look at how these things get reported on actual financial statements. So if we look at debt and stock investment, there are a couple of different categories that we can put them in, and they're on the page 11. The first option would be trading securities, which means that I don't plan on holding them very long. You've probably heard the term day trader. That means that they're not going to hold on to these things. They're willing to give them up today, tomorrow, buy them today, sell them tomorrow, buy them today, sell them later today. So it's one of those things that happens very quickly. Trading stocks, securities are not expected to be held very long. Then you have a little bit broader category called available for sale, which means, okay, I bought these. I think they're going to do something, so I think I'm going to hold on to them for a little while. So you have no attachment to the trading securities. These you've got a little bit of an attachment to. And they say, okay, I'm going to hold on to them for a little bit, see how they perform. If the right price comes up, then I'll sell them. Okay, so they're available to be sold. Then you've got the ones that you just absolutely adore and love and wouldn't never sell for your life. Those are held to maturity securities. So you're going to hold on to them no matter what. And there are people out there that do that. So those are your three options: trading, available for sale, and held to maturity. Know for the test that as far as trading securities goes, those securities are bought and held primarily to be sold in the near future to generate income on short-term price differences. So I want to capitalize on buying it here. It's moved up to here. Okay, I want to make this much then. Okay. Those are held for usually less than 1 month, and trading is the same as saying frequent buying and selling, basically. Those will be reported at fair market value at the end of each period, with the changes being reported as part of net income using an account called unrealized gain or loss. So that's a new account for you. The offsetting account will be called fair value adjustment trading. So if they're trading securities, your fair value adjustment account will have the notation at the end that it's for trading securities. So the two accounts that you're going to be using is unrealized gain or loss, because you're not selling them, so it's not a realized gain or loss, it's an unrealized gain or loss. And then fair value adjustment, and in this case you would say trading. You have to have this on here, okay? And you have to call it an unrealized gain or loss, because you are not really selling them, but this is what would happen if you did. Okay, it's basically how I like to look at it. When we're talking about those two accounts, the fair value adjustment trading is going to be netted against the investment account to achieve the fair market value for the securities right now. That will be the amount that's used on the balance sheet, so that you're reporting them at their true value currently. Using this account will allow the main account that you put them in to still show cost. So it's kind of like offsetting, and similar to like the accumulated depreciation or the allowance for doubtful accounts for accounts receivable, is adjusting that accounts receivable account. The accounts receivable is going to stay at the full value, but the amount that you don't expect to collect will be shown in allowance for doubtful accounts, leaving what you really do expect to collect on your balance sheet as the net cash realizable value. It's the same thing here. You're going to start with your trading securities being listed at cost. You're going to have this fair value adjustment trading account underneath it, and then you're going to show the actual reporting fair market value for the securities. Let's see if I can find. If you look on page 15, it just shows it netted. It shows debt investments at fair value, which means they've taken the debt investments account, they've adjusted it with this fair value adjustment, and then this is what it's netted to. Same thing with the stock investment at fair value. So they've done the same thing, only they just went ahead and netted it out behind the scenes. So what we're going to do for trading securities and available for sale securities, so we're going to take a look at their values. So if you look at the bottom of page 11, at illustration 16:7, you'll see a little chart. And that's kind of what you have to do. You're going to start with the things that we are investing in. In this case, we are invested in Yorkville company bonds and Kodak company bonds. You look at the cost and the fair value. So the cost is, what did I pay for them? The fair value is, what are they worth today? And you find out the difference between the two. So Yorkville cost me $50,000. Its fair value on the market today is $48,000, which means if I sold it today, I would have a loss of $2,000. Not selling it, that's why it's called an unrealized loss. Kodak company bonds, I bought them at $90,000. Now they're worth $99,000. So if I sold them today, I would have a $9,000 gain. I'm not, so it's called an unrealized gain. So then you net those out because those are both trading securities. In our little note here, it says trading securities. That's a $7,000 gain overall for trading securities. Okay, if you flip the page, you'll see how we record that. You're going to put that as an addition to your trading securities, which would be a debit. So fair value adjustment trading would show $7,000 debit. Now, when you use the unrealized gain or loss, you have to know where this is going to show up. If it's trading securities, we say income. So it's fair or unrealized gain, in this case, income. If it was flipped and we ended up with an unrealized loss, then we would debit unrealized loss income and credit fair value adjustment trading for the $7,000 difference. Available for sale securities, you're going to kind of pretty much do the same thing, only you're going to list the fair value adjustment as available for sale, not trading. And the other difference is that unrealized gain or loss that you're recording won't show up on the income statement. It'll show up on the balance sheet, so we say equity instead. So available for sale securities are going to use equity, trading securities will use income. So you have to make sure that you have those little tags at the end so that I know you've completed that entire account title. So the yellow box on 12 is for available for sale securities. Going to look at the same thing. Campbell's Soup cost us $93,537. Today the fair value is $103,600, which would be a gain if we sold them today of $10,063. Now, I don't know who made this exercise up, but I think they have these companies backwards because they're telling me Hershey's Foods, which is chocolate, went from $200,000 cost to $180,400, which would be an unrealized loss of $19,600. So somebody is a little whacked out because I think chocolate is better than soup any day of the week. But anyway, in this exercise, if you net those the gain and loss out, you still show a loss. If I sold them today, it would be a loss of $9,537. I'm not selling them today, so I'm going to put it in the unrealized loss equity account. If you look on page 13, as a debit of $95.37, and credit fair value adjustment available for sale, $9,537. So that is how we're going to handle the trading and the available for sale securities. I'm going to go back and work a couple. And the reason for the difference is because the trading securities are traded very frequently. So therefore, you're going to show that short-term loss on your income statement. The available for sale securities, you're going to hold on to them longer. So therefore, they're going to be part of your balance sheet for a longer period of time. So we call that our equity section. So that's my explanation of why we're choosing income or equity. Let's go back and take a look at a couple of examples. Let's look at brief exercise 6 on page 25. It says, in its first year of operations, Godfrey Corporation purchased available for sale debt securities costing $72,000 as a long-term investment. At December 31st, 2022, the fair value of the securities is $68,000. Prepare the adjusting entry to record the securities at fair value. So again, you have to take a look at the cost of it versus the fair value. It cost me 72. its fair value right now is 68. If it cost me 62, it's now worth 68 on the market. If I sold it today, I would have a loss of $4,000. I'm not, so it's considered an unrealized loss. So I'm going to be debiting my loss because losses get a debit. So I'm going to say unrealized loss and these are available for sale securities, so that would show up in my equity section of 4,000. And then I'm going to say fair value adjustment is always going to be my other offsetting account. And I'm going to say available for sale securities, 4,000. Let's take a look at Do It 16.3 on the other page, page 25. And we're going to take a look at part A. It says, some of Tolkason's corporation's investments in debt securities are classified as trading securities and some are classified as available for sale securities. The cost and fair value of each security at December 31st were as follows. So now we don't have different securities listed, we have different types of securities. So they've listed all the trading securities in one line and all the available for sale securities in the other line. It also gives you your unrealized gain or loss on those companies. And then it says, if I can flip the page. At December 31st, 2021, the fair value adjustment trading account had a debit balance of $3,200 and the fair value adjustment available for sales account had a credit balance of $5,750. Prepare the required journal entries for each group of securities at December 31st. Well, all we're going to do is just record the two journal entries that need to be recorded, one for the trading and one for the available for sale. So the trading securities would show a loss if I sold them today of $11,400. I'm not going to sell them today, so it's an unrealized loss. Losses are debits. So we're going to debit unrealized loss. And because they're trading securities, that loss would show up on my income statement. Because they're trading, and that is $11,400. And then I would credit fair value adjustment trading $11,400. That's the first entry. The second entry then is to record the available for sale securities. That would show a gain if I sold them today at $4,200. So if a loss is a debit, a gain is going to be a credit. So unrealized gain. These though are available for sale securities, so it's not income, it's equity of $4,200. The offsetting account is always fair value adjustment. This case, they're not trading, they are available for sale, $4,200. So taking a look in the book then, how we are going to show things on the balance sheet. So looking at page 14 and 15. Short-term investments are considered marketable securities. Those are securities that are held by a company that have to be two things: readily marketable, and you have to have an intent to convert them into cash. You need to know those two things for the test. So know that on the top of 15, short-term investments have to be readily marketable and intended to be converted into cash. And that conversion is expected to happen within 1 year or operating cycle. Those will be shown underneath cash using the fair market value. You can see that in illustration 1612 and how that's going to show up. They're temporary investments. You don't expect to hold them for very long. Then you have long-term investments. This is the one we looked at earlier. Those securities are the ones that don't meet those two qualifications. So they're not readily marketable and you don't intend to convert them into cash. Those then would be considered long-term investments. Those are going to be reported at fair market value and a separate section underneath current assets in its own little area called investments. Okay, they are not readily marketable, so you're going to hold them. Now, the way that we present real unrealized and realized gain or loss, it's going to be covered on 16, page 16, illustration 1614. Other revenues and gains would be interest revenue, dividend revenue, gain on sale of investments, and unrealized gains. Other expenses and losses would hold a loss on sale of investments and unrealized losses. So they're going to show up in the other section of your income statement. Both realized and unrealized gains for trading securities would be reported in the non-operating section. So you can see trading securities would show up in this other section of the income statement. Unrealized gain or losses on available for sale securities will be reported under the stockholders' equity section of the balance sheet. So if you look at illustration 1615, that's the stockholders' equity section, and the red there is where you would show that unrealized and realized or unrealized gain or loss for the available for sales. Reporting investments at fair market value will apply to both debt and stock investments. So you're going to have to make sure that you've got it all covered in here. You can see the classified balance sheet on both pages. There's 16 and 17 and how that's going to look in the end. Okay. That is it for chapter 16. Like I said, about an hour, so not too bad. On your homework, take note that on exercise 16.3, I want you to leave all the numbers in the calculator when you're computing the amount sold. So if you have 3 fish, you're going to take 3 divided by 5 and then multiply that by your cost of your investment. And then also note that exercise 16.11 will use 16.10 data, but it makes that data available for sale securities, not trading. So 16.10 is going to do it as trading, but I want you to do 16.11 because available for sale securities is what you'll be doing on your test, not trading. So I want you to practice it as available for sale securities, not the trading. And then on 16.4, it looks like the only thing I want you to do problem is part B. Let me get back here and take a look at it. 16.4. Yes, so you're going to use the equity method. So you're going to be that middleman holding the 20 to 50%. And that's what's also going to be on your test, not the cost method, this less than 20%. So kind of got you set up here to do the things that are similar to what you're going to do on your test. Make sure if you have any questions on any of the homework or any of the homework for points online that you give me a quick message. Talk to you soon.